The buildings don't go away, but the owners do. Welcome back, guys. Today, we're going to delve into the urgent marketing warning from none other than Charlie Munger, the late business partner of billionaire investor Warren Buffett. Some pretty ominous signals flashing in the commercial real estate sector. In his final appearance at Berkshire Hathaway shareholders meeting in May of 2023, Munger's cautionary words to everyone were, "The buildings don't go away, but the owners do." Looks like he foresaw a looming storm in the sector that could potentially ripple through banks and the wider market, with downtowns hollowing out both in the US and globally. Munger predicted a significant and unpleasant shift in commercial real estate ownership, and recent data from business networking platform Alignable seems to corroborate this financial warning, with 45% of real estate agents struggling to pay office rents in November, marking a troubling increase from the previous months. As mortgage rates soar and housing prices skyrocket, the middle class is now facing barriers of home ownership unlike before, prompting questions of whether this could be the end of the American middle class dream or possibly never ever owning a home again. But will the real estate market change this year? Join us as we explore these warning signs and ponder whether the tide will turn in the coming year. But here's a clip of Warren Buffett and Charlie Munger warning their shareholders about the storm brewing and business owners possibly going away. Check it out.
Well, Berkshire's never been very active in commercial real estate. It works better for taxable investors than it does for corporations taxed the way Berkshire is. So I don't anticipate huge effects on Berkshire, but I do think that the hollowing out of the downtowns in the United States and elsewhere in the world is going to be quite significant and quite unpleasant. I think the country will get through it all right, but as they say, it will often involve a different set of owners.
Yeah, and the buildings don't go away, but
the owners do.
The buildings don't go away, but the owners do. Charlie Munger, Warren Buffett's late business partner and legendary investor in his own right, was pretty clear in this warning and bear case against the commercial real estate market, foreseeing a storm that could potentially hit banks hard and affect the broader market this 2024. Now, Charlie Munger also mentioned the significant and unpleasant impact expected on downtown areas in the United States and pretty much everywhere globally. So in his last shareholder meeting with Berkshire Hathaway investors, that's when Charlie Munger predicted the U.S. economy will weather the storm, but the commercial real estate will eventually involve a different set of owners. Translation: business owners will become business losers in what's going to be a major change in ownership of commercial real estate. Now, some recent facts, guys. Foot traffic near stores in metropolitan areas is 10% to 20% below pre-pandemic levels. Meanwhile, office attendance is 30% lower than before COVID, at least according to the latest McKinsey report. The management consulting firm predicts that because of these trends and other factors, demand for office space could be almost 20% lower in 2030 than it was in 2019. And as you can imagine, this situation spells a lot of trouble for commercial landlords, and it spells even worse news for their leaders, mainly regional banks, the likes of which we saw crash not too long ago. You guys remember Silicon Valley Bank and Signature Bank, right? Yeah, those were regional banks too. Charlie Munger himself highlighted the U.S. banking sector's exposure to bad loans in commercial real estate, warning that higher interest rates, reduced rental income, and declining property values could easily lead to some loans surpassing the property values that they're based on. And so what happens after the crash? When small banks struggle and the economy crashes, the trillion-dollar banks will be the ones buying everything at low prices and consolidate even more wealth. This is exactly what happened in 2007 and 2008. While everyone got wiped out, the gazillionaires used their access to capital and 0% interest rates to buy up everything. This is exactly why the wealth gap has become so dramatic over the last decade or so. More on that and the danger for the middle class in the current housing market later. Make sure you guys stay tuned. Oh, and if you want to stay ahead of the curve, make sure you hit the like button and subscribe to the channel. Don't miss out on staying informed in these uncertain times. I want you guys to know that your support means the world to me, and together we can navigate this financial market as best we can. Oh, and by the way, if you own a home, make sure your home is protected. Get your free home warranty quote. There's a link in the description down below. It takes about 10 seconds. Now, interestingly enough though, Berkshire Hathaway has never really gone into the commercial real estate market. According to Charlie Munger, it's really a better fit for taxable investors than for corporations with Berkshire's tax structure. So instead of venturing in the commercial real estate, the company has been actively pursuing opportunities in the more profitable domain of residential property development. You can check it in the stakes that they put in various home builders over the years. Their portfolio now boasts significant positions in D.R. Horton, Lennar, and NVR. All of these companies could reap the rewards of a potential boom in home building. Right now, the National Association of Realtors reports a housing shortage ranging from 5.5 to 6.8 million million units. That's because there have been more households formed than homes built over the past decades since the great financial crisis. Now that lumber prices are lower and there's persistent demand, investors are betting on a housing boom. Now, if you're curious about jumping into this investment space, retail investors can explore publicly listed home builders or just buy a share of them with the S&P SPDR Home Builder ETF. Now, it's worth noting, however, that while residential property development and home building investments may seem promising, all investments do come with risks. The real estate market in particular can be unpredictable, influenced by various economic factors and unforeseen events. Not to mention, I'm not a financial advisor. This is not financial advice. We're just having a conversation here, folks. Now, before diving into the sector or any new investments for that matter, I always recommend investors should conduct thorough research, consider potential market fluctuations, and be aware of their inherent risks. Past performance of home builders and related ETFs is not necessarily indicative of future results. Additionally, individual investor goals, risk tolerance, and financial situations can vary, so you will need to tailor your investment decisions accordingly or even consult with a financial advisor. I am not one. Now, speaking of, another warning that could open up the possibility for an investment opportunity somehow, well, 45% of real estate agents who own their firms said that they had trouble paying their rent on their offices in November. Now, that's 5% higher than in October and 10% higher than September's reading. Now, this is coming from referral network Alignable. In their latest study, realtors reported that persistently high interest rates, the average 30-year fixed rate mortgage remains at about 7%, and this has made home sales a little bit more difficult to finalize. They say that the Federal Reserve has put us in this tight spot where they essentially froze up the residential real estate market by holding interest rates low for so long and then increasing them so much so quickly. And so now we've got this incredible distortion in our marketplace. And when the housing market suffers, people who work in that space lose their jobs. Unless you work in loss mitigation, you are likely at a loss. This will happen to people who work in commercial real estate if the storm is taken off. The real estate agents, the brokers, the servicers, the underwriters, the people in the back office supporting the loan transactions. If your income is from that type of work, now may be the time to prepare. In the past year, home sales have hit a major slump with potential home buyers getting cold feet due to high interest rates and pulling out of the deals faster than ever. In fact, this downturn has not only left more real estate agents without work, but it's also slashed their income. In October, pending home sales took a nosedive, dropping by 1.5% from September and a whopping 8.5% from the previous year. This marks the lowest pending sales figure since the National Association of Realtors started keeping track. And just to kind of put things into perspective, the situation is now even worse than what we saw during the 2008 financial crisis. To make matters worse, the real estate market is expected to shrink, leading to a decrease in the number of realtors across North America. In the 6 months leading up to May, over 60,000 agents already left the industry. And despite the recent decline in mortgage rates, they haven't quite gotten low enough to entice homeowners who locked in rates between 2 to 3% to list their homes for sale and make a move. So, as you can imagine, inventory's in a real crunch right now. Now, at this point, people are saying that the only real solution is to pass a federal law that prohibits companies and firms from buying residential estates, then release the estates that the company's firms already owns back to the banks gradually. But what do you guys think about that? Owning a home is likely the most significant asset in most people's financial lives. It's not just about having a place to live. It's a powerful financial tool that can potentially unlock stability and preserve wealth for generations to come. The magic lies in home ownership acting as a key to financial security. Every month, you make those mortgage payments, you're not just covering the costs, you're adding to the household's wealth. It's like being automatically enrolled in a savings plan. With every payment, you chip away at the mortgage debt, building equity, knocking out both the principal and the interest, and ultimately building up wealth through equity for you and for your family. Think of it this way. Becoming a homeowner essentially transforms you into your own landlord. Instead of paying someone else, you're paying yourself first. And according to data, this gradual wealth building process throughout home ownership is a pretty effective strategy over time. But a lot of middle earning Americans are finding that owning a home in America is beyond their means. Most people making a median salary of $75,000 per year, which is what 51% of Americans earn, can afford a home that costs about $256,000. But unfortunately, the median home price in the United States today is $431,000, at least according to the Federal Reserve economic data. You see how the math ain't quite mathin'? And even if enough homes were available, monthly payments have gone up compared to even just a year ago. Recent analysis by Oxford Economics showed that a median price home was now 13% more expensive for a median size home. In the third quarter of 2023, a median sales price of a house at $431,000 cost $12,500 more from the previous quarter. The housing market is basically locked up. No other phrase has defined the 2023 housing market as much as the mortgage rate lock-in effect, which is basically a phenomenon that brought the industry to a standstill, putting downward pressure on everything from inventory levels to home sales. The pandemic era sub 5% mortgage interest rates that 85% of mortgage holders are locked in kept homeowners from selling their homes and buying another at elevated interest rates, which of course ultimately peaked at roughly 7.79% the week ending October 26th. But the question is, will things change in 2024? Well, for a bit of good news, there are signs that the market conditions will be improving. Mortgage rates have dropped steadily over the past 7 weeks, averaging 6.61% for a 30-year fixed rate mortgage the week ending December 28th. Experts are predicting a positive turn in the market as mortgage rates have plunged in recent weeks. Now, the question is, will that translate into tangible affordability for the American people? That is something we'll probably have to answer in another video, guys. Just make sure you're always tuned in, all right? And hey, drop your questions and requests for future content in the comments. You know I'm always here coming up with new videos for you guys, and I need as much input from you as you can share. So don't hesitate, drop me a comment down below. I read them all. I'll see you guys in the next one.